Hello, everyone. Today on the Final Bar, we will wrap the week, our normal Friday routine of focusing on how the markets have evolved from last Friday to this Friday. Overall, the S&P giving further upside indication, finishing in a position of strength through the course of the day, up about 0.75%, led higher by some of the growthy stuff, communications, services, and technology. Also, some of the cyclicals, industrials, and materials. There's very much a risk-on feel to the day. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to this Friday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on this market environment using the power of technical analysis, power of stock charts to better understand market dynamics. You know, and it's interesting when we look at the last couple of days, look at readings on breadth and sentiment and price. And if we think of it in that order, you know, in terms of breadth, overall fairly constructive. I'm thinking of my conversation yesterday with Joe Duarte, which was really interesting. He shared a chart within the industrial sector, but also focused on breadth. And his comment was, the advanced decline line making new highs, you have to be constructive, right? Overall, you have to feel that's more positive than negative. And I would agree. Sentiment, we looked at a little more detail on yesterday's show as well. And we looked at how some of those indicators are becoming a little more extended. The name exposure index getting to elevated levels, the RIDEX flows at all-time lows, indicating investors are all in. But at the end of the day, all of that matters a lot less than price. The price of the asset is the most important gauge of investor sentiment and the push and pull between supply and demand. And overall, you're seeing risk assets net out more positive. Today was less about growth over value or value over growth and more about risk on versus risk off in a show of strength to finish this week after a little choppiness. Overall, I think setting up for further upside going into the remainder of November, potentially into December and beyond. Number of great guests on the show. Had a lot of fun talking with Joe Duarte yesterday. Next week, we have Jesse Felder on Tuesday the 16th. On Wednesday the 17th, Javed Mirza, technical analyst at Canaccord Genuity in Toronto. On Thursday, Bruce Frazier, Wyckoff expert and educator, successful educator, and host of Power Charting on StockCharts TV. We were going to take the Thanksgiving holiday off, so the 24th through 26th, no new shows, but we'll have a lot of great programming for you and a couple specials just to announce to you. First off, all next week on StockCharts TV at 11 a.m., we'll be doing a special series called Chart School. Julius DeKempener, Grayson Rose, Tom Boley, Greg Schnell, Aaron Swenlin all sat down with our producers and shared how they use the chart list features on stock charts. And I would encourage you to check those out. You're going to pick up a lot of great ideas about how to set up your own login and how to better understand the market environment. That's all next week at 11 a.m. Eastern every day. Also, my next free webcast through Market Misbehavior will be coming up next week on Tuesday, November 16th, 1:00 p.m. Eastern. It'll be called Small Cap Stocks, What, Why, When, and How. We will talk about what small caps really are. What do they represent? Why are they important right now? What does this breakout in the Russell 2000 tell you about risk on versus risk off? We'll talk about when these types of stocks tend to work, these more risk on higher beta names, and how could you play these using different vehicles, individual stocks, ETFs, and so forth. So it should be a lot of fun. We'll break down the small cap space and hit home why I think it's an important area to focus on. That's Tuesday, November 16th. You can sign up for free at marketmisbehavior.com/smallcaps. Let's continue on our segment, our show today with our Wrap the Week segment. We're going to start with a poll. We always have a poll running on our StockCharts TV live stream page, also through social media. And we asked you recently, which of the FANG stocks performs best over the next 3 months? And we gave you the 5 names: Facebook, Apple, Amazon, Netflix, Alphabet. 34% and 29% were the 2 highest respondents. And that was sort of a tie, I would call it, although Amazon narrowly beat out Alphabet for the top 2 spots. You know, I'm going to bring up a particular chart in this list. I have the FanMag list, and I have the 6 FanMag stocks on here. This is the FANG Plus Index. Then we have Facebook, Apple, Netflix, Microsoft, Amazon, and Alphabet. And what's interesting is these last two, these are the ones that had the biggest respondents. I don't disagree with Alphabet. And I think when I'm looking at these 6 names, a couple of them stand out. And I've talked about how Netflix is probably my favorite of the group, and I would stick by that, given the overall strength and the fact that it's emerging from a base. Some of these stocks, particularly Microsoft and Alphabet, are a little extended, meaning they've had a pretty good run already. Now, I would argue that things like Microsoft and Alphabet make decent core positions. And the reality is, if you own something like the Qs or the Spiders or something, you have a good exposure to these mega cap names already. Amazon, I'm a bit surprised at, only because it's probably one of the least attractive charts out of the 6. The 2 that I think are lagging behind in a pretty big way are Facebook and Amazon. So many of you buying into the upside potential on a stock like Amazon, I'd be interested to see if it can get above its previous highs. Some of these other ones have already demonstrated their ability to make its new highs. Amazon has demonstrated its inability to follow through on the upside. Maybe that's changing this week, and that's what we're picking up on. If I voted, I would have picked on Netflix, and I put a video on my YouTube channel called Market Misbehavior maybe a week or 2 ago, looking at those 6 stocks and making an argument for which ones are the strongest. So check out the Market Misbehavior channel if you have not done so. Let's continue to wrap the week. We will look at our wrap the week chart. That is this one right here. Color coded for the major asset classes. If you follow my mouse and my voice, I'll show you what happened over the last 5 trading days. So we start the clock last Friday. We go through the next 5 days, and here's what happened. The S&P finishing the week down about 0.25%. That's that there in black. A number of things underperformed the S&P. 3 of them are clustered right around down 1% for the week. And that's 3 things. Crude oil prices using the USO, that's the line in brown. The line in purple is the small cap index, so the Russell 2000 ETF, the IWM. And then in pink, this is the NASDAQ 100. So what's interesting is small caps and the NASDAQ both actually relatively weak into the middle of the week, and then actually turned higher and finished a little bit stronger going into Friday, but overall just recovering enough to be down 1% from the week. The worst performer out of this group is bond prices, the TLT, which is down 1.3%. We've talked about the prospect of higher rates. We've talked about the influence that a higher rate environment can have on a number of different sectors and the market as a whole. You certainly saw some of that with the Fed meeting, with the discussion about what a tapering is going to potentially look like, and how the Fed's actions over the next year certainly could impact leadership themes, but especially the markets as a whole. And certainly higher rates and lower bond prices are the trend that I see continuing for the foreseeable future. But the charts will tell us when that may change. Now, the rest of these were up for the week. You had the dollar index using the UUP up 0.9%. In orange, we have the emerging markets up 2.2%. So what's interesting is, as the dollar's actually up, which should mean better U.S. than non-U.S. stocks, generally speaking, emerging markets actually had a really decent week, strongly outperforming the S&P 500 in a week when the dollar was actually stronger. So it's a good reminder to not just focus on the dollar and think that's it. There are a lot of moving parts, a lot of themes that are interrelated here. The best performer of this group is gold, up 2.7%. We highlighted the chart of gold yesterday. It was one of our 3 and 3 charts. The GLD finally getting above 172, I think, is very, very important. Number of gold stocks showing what are called head and shoulders bottoming patterns, including the GDX breaking out to the upside and showing certainly a potential for further upside going forward. We add Bitcoin to the mix, which ended up being up 5%. Big move, into over the weekend, really into Monday, where it was up almost 10% from last Friday. Settled down a little bit, but overall, certainly in a position of strength. The chart of Bitcoin is actually a little concerning. We're going to get to that here a little later if we have time for it. But basically showing a bearish momentum divergence, which I think is something certainly to pay attention to. That's not been a good sign for Bitcoin previously during the year. Let's continue on and finish off our Wrap the Week segment looking at the Mindful Investor live chart list. If you've never watched one of the shows on Friday, you can access this list as a list I maintain on StockCharts at all times. You can go to the Articles tab at the top of StockCharts where it says All StockCharts Blogs. Go to my page, which is called The Mindful Investor. And at the very top, you'll see this gray button that says Live Chart List. And that's going to get you to this list of charts, which we'll review now. We're going to start with the market trend model. This is a model that I started using years and years ago as a way to try to capture the overall tendencies of the market and try to think about the three timeframes that I pay attention to. One is the secular, the long-term time frame, a couple months to a couple years, really looking at the big picture returns. And it's meant to remain bullish unless the trend really reverses to the downside. It's only been below zero twice over the last 5 years, at the end of 2018, at the beginning of 2020, and has remained bullish for the last year and a half, the whole time. The medium-term model for me is based on the weekly MACD, or the weekly PPO. This actually just generated a buy signal in the last week. It's been actually pretty interesting to watch the MACD during 2021 because it's remained negative for the last 6 months pretty consistently as the S&P has gone higher. And while this has been helpful to help me think about the downside potential, it's matched the performance of the cyclical sectors pretty well. So if you look at the chart of the financial sector, that's actually been a pretty good gauge of risk on versus risk off. But for the S&P, it's followed it a little less ideally. And so I'm actually in the process of rotating to a different medium-term model, which I'll hopefully be sharing with you here pretty soon. I'm working out all the details and working with my current subscribers to share with them all the details on that first. The short-term model is based on literally where we're at relative to the 5-week exponential moving average, and that is just a quick visual gauge to see whether the short-term trend is positive or negative, and has been positive for the last 5 to 6 weeks. So overall, across the board, this is positive, essentially saying on the long-term, medium-term, short-term trends, the trends are all fairly constructive. And what that tells me as an investor is to be thinking risk on, to be looking opportunistically for names that have further upside potential, to follow trends until proven otherwise, and to hold things that are working and to leverage into things that I think are showing further upside potential. And that's why we'll be talking about some of the things that are showing some strength here. Now, I will tell you, even if you're constructive, which I am at this point, given the seasonal strength of November and December, given the strength in charts that I'm seeing in the improving breadth conditions, I am always thinking about the alternate hypothesis. And anytime you hear me saying or implying that I'm bullish, I'm always thinking about negative scenarios. And the same thing, if and when things get really bad, I will be talking about the ways that would convince me to turn otherwise. And if you hear how I talk to a lot of our guests, I always try to ask them a question implying the opposite, right? So if someone's bullish on a chart, I ask them what would convince them that the opposite is playing out, right? What would tell them that the bullish play is not correct anymore? So looking at a chart of the S&P 500, it's recently broken to new all-time highs. That's constructive. The RSI, the measure of momentum, is overall in the bullish range. That's constructive as well. We've pulled back, and on recent pullbacks, we've made higher lows than the previous pullback. So all of that is constructive. So what would tell me things are different? Well, number one, we were overbought and we came out of that overbought region. A lot of times that tells you we're sort of due for at the very least, a short-term pullback. So I think that's what we're seeing through the course of this week for sure. That's something to pay attention to. But as we do pull back, if we would pull back further next week, 45.50, I think, is the key level to pay attention to. It's all about looking left on the chart and seeing where significant levels have happened. I think 45.50 was a key resistance level. After that was the peak in September, and then we pulled back, the deepest pullback, a huge drop of almost 6% that we saw from early September to early October. And I say that with a great dose of sarcasm. We then recovered those highs and broke out. And a lot of times those breakout levels will become support levels. Excuse me. We saw that in the May peak when the S&P moved to a high in May, pulled back, broke above there, and then retested that breakout level before rotating to new highs. We could see a similar pattern here. And that's why 45.50 is an important one. Not too far below that, you have the 50-day moving average around 4,500. And that's why that range, I'll probably put a little shaded area there pretty soon, indicating that as the key pullback level to look for. If we would break that for some reason, I would be looking further down to around 4,300, maybe a little below that. And those are the lows from September and October. That would also be the 200-day moving average, all clustering around that level. That's not too far off from where we're at. I mean, that would be a retest of the October lows. That would still be a fairly constructive price pattern, but would, certainly be the deepest pullback we've seen in over a year now. So overall, the chart very constructive. 45.50 would be the line in the sand I would be paying attention to. Can we hold that? If so, I would argue that the charts are still pretty constructive. Joe Duarte yesterday mentioned the advanced decline line. He was using the NYSE AD line, which is totally fair. And I agree with his assessment that the breadth conditions are overall very positive. And, you know, the reason why I have this chart and I've color coded them green, amber, or red subjectively based on what I'm seeing with the trends is it's a reminder to not fight the breadth, the trend in the breadth indicators. This tells you what the stocks that make up those major indexes, what they are doing collectively. And when you see the market going higher, but the breadth conditions deteriorating, that tells you to be a little more cautious. That's what caused me to be a lot more cautious back in May and June, because you saw the market go higher on lower breadth readings. Now we're seeing the opposite. We're seeing the market going higher, and we're seeing all these breadth readings breaking to new highs. So what that tells you is overall, the market is in a fairly strong state. You're seeing a lot of stocks participate in this upside. It's worth noting in the last 6 weeks, 6 weeks ago, 25% of the S&P members were above their 50-day moving average. Currently, it's just below 75%, which means literally half the S&P 500 members in the last 6 weeks have gone from below their 50-day to above their 50-day. That only happens in a bull market phase. That is a bull market sort of tendency when you see a lot of stocks regaining that short-term trend gauge. So certainly something to pay attention to there. We talked about sentiment yesterday, so I don't want to beat it any further. Let's continue on here. This ratio of offense versus defense using the consumer staples and consumer discretionary sector, excuse me, if this is going higher, that's risk on over risk off, or put another way, offense over defense. We've seen a bit of a pullback this week, but overall, you can see both of these recently making new highs and breaking to new swing highs. The equal weighted version in particular reminds me to think constructively overall in the market environment, and that investors are doing so as well. Finally, the relative strength in semiconductors breaking out, and I'm seeing some strong charts in that space. Some charts like NVIDIA and Xilinx, XLNX have been fairly strong for a while, but I'm seeing other ones, things like Micron and others that are breaking above recent swing highs. That's a space I would focus on if you've not been there, if you've been avoiding them for some reason. Look, and not just through the big, strong performers year to date, look at some of the ones that have lagged behind a little bit because they're all starting to participate, I think, here going forward. We need to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I mentioned usually in the introduction the weather conditions around Redmond, Washington. I mentioned, as you probably have sensed, rainy is usually the adjective I use. We're actually getting incredibly heavy rains right now in the little town I'm in, just east of Redmond. We become an island because all the roads leading out of the town flood. So we are in the midst of that immersion underwater here. So think good thoughts for those of us in Western Washington dealing with excessive rain, more than we're normally used to. A couple quick announcements before we get to today's mailbag. Number one, our questions come from all of you, and we appreciate all the questions that you sent us since we started the show. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on the StockCharts channel. We'll hope to hear from you very soon, and we'll hope to answer your question live on the air in our next mailbag segment, which will be Tuesday of next week. Also, go to StockChartsTV.com. That's our on-demand platform. There's so much great content on there to help inform, educate, inspire, and help equip you to make better decisions for your portfolio. You can go to StockChartsTV.com, use your email address to set up a free account, or on your mobile device, just look on any of the app stores for StockCharts TV on demand. I want to continue on today's show with the Final Bar mailbag. Again, all of these questions have come from you in the last couple of days. We appreciate you emailing us your questions. Let's get to it. Question number one, can you also analyze the Indian stock market? I've had a number of questions to focus a little bit more on India, and I apologize for not maybe doing it as much as I could. You know, it's funny, in general, what I found over my career is I focus on non-US markets, and it's a cyclical pattern. When the dollar tends to be weaker And where it benefits US-based investors to go abroad, I will tend to focus a lot more on it. The problem we've had with this environment recently is the dollar overall has been fairly strong relative to other currencies. US markets have been performing so well compared to other non-US markets that it's hard to justify, I would argue, for a US-based investor to look outside the US, just because there are plenty of opportunities here. So as a result, I really haven't paid attention. I mean, haven't really focused on them as much. I do pay attention to them through the course of my normal daily and weekly routines. And if you've noticed, when I have mentioned the market, it's probably been India. We've talked about China, certainly, leading to the downside and struggling a little bit. But in terms of an example of a good chart, if I had to be outside the US, if I had an international sleeve and I needed to be somewhere, India probably would be one of the places I would be looking. And I think what impresses me on the chart of the INDA, and I know there are plenty of indexes that we could use to better, indicate this market for if you're based in India. So apologies for that, but the INDA is an ETF that I know a lot of US investors use, and I tend to start with there. Start there as a proxy for the Indian market as a whole. What I like about the chart of the INDA is it had this beautiful stepwise motion in 2021. So you made a higher floor, right? You sort of had this new support level in January, retested that in April, we broke to new highs. We had a new floor in June, July, August, we broke out, and now we've arguably made a new floor in September, October, and we rotate higher. Now, a lot of other markets have broken support and have failed to hold support and rotated lower. India has actually held those support levels pretty well. And I would say it's not just that, broader market, looking at some of the larger names in their Reliance Industries, which I believe is the largest by market cap in India, but I might be wrong. Let me know if I'm in the comments on YouTube or elsewhere you're watching the video if I'm incorrect on that, but I think that's right. And overall, I'm seeing a nice basing pattern. It reminds me of what Amazon looked like in July before it failed, unfortunately. But generally speaking, this sort of pattern, we have a basing pattern, multiple months, sort of a stable range that you're in, and then you break to new highs, retest that breakout level, riding the 50-day moving average higher. I see that as a fairly constructive chart. So I don't have a problem with the market with the largest names looking kind of like this chart of Reliance Industries. So that's my overall take. I think it's very constructive. And I think holding those previous lows on any of these charts that I just showed you would be key to remaining fairly constructive in India. The next question is a little longer, so I summarized it on the screen, but I'll give you the quick version here. I prefer linear scale charts using the vertical price axis on stock charts when dealing with daily charts of longer time periods of 10 to 20 months, because when annotating a channel, for example, it is a true linear channel with a distinct percentage of stock's growth. When drawn on a logarithmic chart, I believe a straight line rising left to right actually represents parabolic growth. On StockCharts.com, what is a quick way to redraw a chart on log scale and linear scale? And you included this chart with you, and thanks so much for sending that to me. So I understand your question. I'm going to disagree a little bit with how you phrase it, because what you said was when you draw a channel on a linear chart, it is a distinct percentage of stock's growth. And that's actually not true. When you draw a linear channel on a linear scale, which is what you're doing, you're actually not plotting a consistent percentage rate of growth. You're actually drawing a linear trend based on price. So this is a trend that has a consistent dollar value, right? Because each vertical space is a certain dollar value. It's equidistant for each dollar. And so when you have a line that remains stable, that just means the dollar value is consistent in those gains. And the reason why you should be using log scale for longer term charts is because this actually misrepresents the trend. What this implies is that it's a consistent trend, but your experience as an investor is going to be a declining trend because the percentage is actually decreasing as this line is going higher. If you take the same chart and the way you switch it to answer your question is below the chart, you have log scale. In ACP, by the way, you have the same setting where you can change it from linear to log scale. That's in the settings for the chart that you're looking at. We now are changing the chart to a log scale. What this shows you on the S&P is that the pace of the uptrend has actually declined a little bit. So when it looks like the trend is actually slowing down, that's actually more accurate. That represents what your experience has been as an investor. And so the general rule of thumb, the best practices of technical analysis are shorter term charts. If you're looking at like a one-day chart, either scale doesn't matter. Linear scale is more commonly used because it really doesn't make a huge difference. But if you're looking longer term, more than a month or two, I would strongly encourage you to use log scale charts. That is what the discipline really requires, because It's a better representation of the experience, the percentage moves on a chart over time. And if you look at something like Bitcoin or the S&P and you don't use log scale, some of the moves are going to be greatly exaggerated, particularly when it trades at a low value because of your scaling and not because of the actual trend in the chart. So I would disagree with your question. I would encourage you to use log scale on longer term charts. And the way you change it is by clicking on that setting on the very bottom below the sharp chart. Next question. I'm trying to fill in cryptocurrency here. Do you have it? And I'm paraphrasing a series of questions that we have received, both to the final bar and also through our StockCharts support desk, which I'd encourage you to check out. You can click on the help button, by the way, in the upper right corner of StockCharts, and they're there to help answer questions on your account, but especially on how to use StockCharts a little more effectively. So hit them with questions as they come up, particularly if you're looking for something that you can't find. Now, the way you look for a ticker is just type it up in the upper right, in the top of the screen. You can also, in the upper right corner, click on the little magnifying glass. That'll be a ticker search. You can also find all sorts of different things. Now, we have about 150 coins currently on StockCharts. We have most of the ones that people ask about, and I can point them to this page. If you go to charts and tools, there's a whole section called cryptocurrencies that'll get you to this page. This lists them all out alphabetically. You can sort them by whatever you need, and you can probably find what you're looking for there. But if you're searching for Dave Coin, which I don't think actually exists, and it makes me think maybe I should check that out. But if you're looking for a coin that it does not appear that we have, the reason is we just don't have it. We have 150 of them. There are hundreds, if not thousands, that we don't have just because they're relatively illiquid and we don't see them as super important. However, we will add them if we get enough requests to do so. So if you search for it and you see this screen right below there, you see request a symbol, make sure you click there, type in the coin that you're looking for. We literally look at all of those every week, and things that we get a lot of requests for, we will absolutely add them. So please put a request there if you need. We need to wrap to today's show, folks, and go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is the chart of Bitcoin. We talked about cryptocurrencies there, our last question from the mailbag. And I'll point you to this chart. Overall, I see the long-term trend in cryptocurrencies as constructive. And if there are 2 things that I will tell you, I can't tell you absolutely because nothing is for certain, but 2 things I'm fairly confident in with cryptocurrencies is one, I think the broader cryptocurrency space certainly has room to appreciate a great deal. I think there's a lot of upside for blockchain technology, and a lot of the cryptocurrencies that we are tracking, I could certainly see them going much, much higher than they are now. But the other thing I'm fairly certain about is that the road will be fairly rocky. These things do not move in a straight line, and they certainly move with a great deal of volatility. So this is like trading a penny stock on steroids when you're looking at any cryptocurrencies. And these are even the liquid, most stable ones. Forget about the altcoins, the ones that are a little less liquid and a little less certain. So prepare for uncertainty, prepare for plenty of rocky movements. However, I think an important thing on the chart of Bitcoin now is what's called a bearish momentum divergence. These highs from October to November on Bitcoin have seen lower momentum, a declining RSI. You've seen that 2 other times in 2021, August into September, where you saw higher prices on lower momentum. The next was February, March into April, where you saw higher prices on lower momentum. Both of those times, obviously, you went down. Now, after that first divergence, it's worth noting you had a higher high in both cases, but you continue to see lower momentum. And so looking for further higher highs with momentum not confirming makes it more and more of a potential problem. And I would be looking for Bitcoin on breakdown alert if that divergence continues. Chart number 2, semiconductors. We looked at, or I mentioned in the market recap, some of the semiconductor stocks, things like Xilinx and NVIDIA that have been in pretty good runs, things like Micron starting to rotate higher, which I think are encouraging. The semiconductor ETF, SMH, also SOXX are 2 of the most commonly referred to ones. Pretty solid charts, and breaking above resistance recently is pretty encouraging. While the S&P has made new highs, the SMH has broken above its September peak, making a higher low this week again, and overall the relative strength appreciating in a pretty decent way. I see further upside in that space. I'm seeing strong charts that are continuing to improve. When people look at the chart of Xilinx and NVIDIA and say, well, it's already run a lot, there are plenty of times in the last 6 to 12 months when you could say the same exact thing before those charts continue to go up. So I learned not to be afraid to buy new highs if the trend is in place and you manage your risk effectively. Finally, the third one is transportation services. The industrial sector and the material sector are two areas where I'm seeing emerging strength, a little different look in some cyclical sectors that have been underperforming a little bit recently. Seeing transportation services to make new highs again in the last week or two. These are names you may not be familiar with. There's only one large cap name in that group, CPRT Copart. You also have things like Hub Group, HUBG, and a logistics company. It's sort of an interesting group, and I'd pay attention there. I'll use the industry summary tab to look for stocks with improving relative strength in that group. Folks, that's our show and a wrap for this week on the Final Bar. For StockCharts.com, I'm Dave Keller. Be well, stay safe. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.